Hi, everybody. Good afternoon, good morning. Welcome and thanks for joining us today. We'll be waiting just one more minute to have more participants to join. In the meantime, if I could just ask you to put down your name and the country where you're coming from in the chat so we get to know you a little bit better. Okay. Okay, so I see we already have 50 participants, so I guess we can start. So on behalf of the SCTA Next Gen Council, I wish you all a very warm welcome today. Today's session will be presented by Keith Flury, Head of Research and Analyst at Sucden Coffee. So thanks, Keith, a lot for taking the time for us today. Keith will give us an insight and an update on the global coffee markets. And I guess with the volatility that we've seen recently, we are all very curious to hear what he has to share with us. The format of the webinar will be the same as usual. So there will be a 45 to 50 minutes presentation by Keith, followed by a Q&A session. Feel free to ask your question at any time during the presentation in the chat, and we will be answering them at the end of the webinar. You can answer your question in Spanish or in English, and we'll try to answer both at the end. A big thank you to our partner, Sustainable Harvest, for sponsoring again the Spanish translation. So for the Spanish speaker participant, you can find, same as last time, there's a small icon interpretation in the screen bar, and you can click on that icon, select the Spanish channel, and you will be redirected to the translation meeting room. So I think we're all set on the admin part. Keith, if you're ready, the floor is all yours.
Thank you very much, Sarah. I'm going to firstly share a slide deck in order to better explain. You should be able to see that now.
Yes, perfect.
Okay, a little quick introduction about myself. I am a classically trained agricultural economist who got a graduate degree from the University of Hohenheim in Germany and the University of Wageningen in the Netherlands. My undergraduate comes from the University of California, Davis. I've been studying ag, and then after school went directly into the agricultural markets. I've been an agricultural analyst for something like 16 years. Coffee has been a focus of mine for more than a decade now, and it's always a soft spot in my heart. As Sarah said, I will give now a review of the coffee market, but as she also alluded to, the volatility that we've seen in the last couple of months, last couple of years has been so extreme. There are quite a lot of factors in play here, and so I'm never going to be able to, let's say, cover them all. So these are more a best of a presentation of what is happening, what we think the evolution will occur in the coming years. I'm going to focus really just on the flat price, the futures price, talk a little bit about the supply in the medium term, talk about how demand has changed over the last couple of years, and then translate that into the paper market and how positioning has evolved over the short term and what it may happen and what may happen in the medium and longer term moving forward. And then a little bit of insight into the outside world, which is seemingly even more volatile than the coffee market. So I will only spend a little bit of time talking about this. Firstly, I am going to just give you a little bit of an overview of coffee in general. In front of you is a graph of the futures market, the Arabica futures market since the 1960s. Now, coffee, like other agricultural commodity markets, is very susceptible to a boom-bust cycle. You can see here I've highlighted the boom cycles in blue. These are price increases that are generally 30 to 40% higher than the average the year before. And then, of course, the other characteristic of the boom is that it generally results in a bust. And usually around 1 year later, that is 1 year from the peak, we are down to levels we were at pre-boom, which is interesting if you think about it, because coffee booms are a function of the fact that the market can have very quick supply shocks, but the supply response to price is actually relatively slow because it takes a while for us to grow. But the actual boom bust cycle is faster than that. So the coffee price is actually already anticipating a further increase of supply. Another way to put that is we are in a bust cycle generally before the increased production of coffee from the market as a function of the higher price. Now, in 2021, we had an interesting boom simply because the number of shocks that occurred. I very quickly will go through them and I'll look at them a little bit later, but think about the super cycle bringing in more purchasing from an allocation from hedge funds. There was a drought in Brazil, which impacted the 2021 crop. There was a frost, which is going to impact the 2022 crop. There was a freight crisis and continues to be a freight crisis. And that then resulted in a much lower and a reduction in destination stocks, which then, of course, was illustrated by the reduction of the certs. But interestingly enough, the current rally, the current boom, is somewhat modest. And I'm going to talk about that in a little bit, but it is modest relative to other agricultural and other markets that we see currently. And it is modest in real terms relative to other prices that we've seen in the past 60 years. Mind you, this is the futures price on a nominal basis. Now, I want to compare then coffee a little bit to the other agricultural markets. And this is a very busy slide, but you can see the Arabica price, the futures price in black laid over all of them. And a couple of interesting dynamics about coffee boom bust cycles are: one, the boom part of the cycle is actually generally lower than what we see in other agricultural markets. And the bust, that is the low price, is lower than what we see in other agricultural markets. You can see the black line when we go into the bust cycle is quite low relative to the other agricultural markets. This is basically every agricultural market. There are some esoteric ones and there's some mainstream ones, all of which have been normalized to 1970 as an indexed scale so we can compare them. Now, why are the Arabica and Robusta boom cycles lower than the other agricultural markets? Well, that's a good question and probably requires a little bit more research. One of the main reasons, I believe, is that there is a relative comparison or a relative substitute for Arabica in Robusta. So when we see a boom, we anticipate that there is quite a lot of blend change, and therefore we can actually, in some ways, destroy demand before demand is actually destroyed for all of coffee. I'll talk a little bit more about this in the coming slides. But I also want to focus on that idea that we're in a current modest rally. And one of the ways to look at that is simply to adjust prices for inflation. Now, this is an index for coffee prices that goes way back to 1850. I don't necessarily think that what occurred in the 1800s or even in the beginning of the last century is relevant to what is happening now, as we live in a very different world. But what I want to point out is that you can see our current rally, and while it may be similar to what we have had in the last 20, 25 years, it is nothing compared to what we had in the 70s or the 50s. And what I sort of make as a delineation between these two is that in the 50s and in the 70s, coffee market actually did have to destroy demand. And it required a price in which people substituted out of coffee. They went to tea or they didn't drink anything at all. While in the last 25 years, the market has had rallies on supply shocks and stock issues. We haven't actually had to destroy demand. We've probably had to shift demand into Robusta from Arabica, but certainly there has been enough coffee available to meet everybody's demand. And so what these rallies are more likely is a repositioning based on the new risk parameters of a slightly smaller supply. Also, the positioning ahead of the rally is an issue as well. There are two dynamics to this slide. One of them is this table. And in this table, I want to show you what the speculative position was before every rally in the last 35 years. And I'm indicating this as a percentage of the open interest. So it is the speculative short, gross short position as a share of open interest. And you can see in the 90s, they were in the 30s. Then it drops down to the low 20s in 2005 and 2010. 2014, it was 30 again. But in 2021, when we had the frost rally in July, the speculative short position was relatively low at 13%. So in the height of the rally, it dropped to 9%, which means that there was no short squeeze. And that's not the case that occurred, for example, in 2016, when the speculative short was 22% of the open interest and reduced itself down to 10%. And the change in New York was around 31% of the flat price. So one of the aspects of the fact that this rally is, even though there were a lot of things going on pushing prices up, it actually was somewhat modest of its peak so far, was the fact that the speculative position was positioned ahead of it very well. And so you can see here, what I've done is I've taken all of the last 5 Arabica price rallies, and I've adjusted them for inflation. And I've compared them to the month before the rally, and then the rally. And in red, you see what we have in 2021 and 22. And currently, we're in the 14th month of this rally. And as a duration, we are similar to what we have experienced in the past. Sometimes the peak is early in the rally. Sometimes it's sort of in the middle of this dynamic. In yellow, you saw 2013, it happened in the first 4 or 5 months and then sort of tailed off. And so the big question is now, is the flat price move that we have seen in New York done? Is the boom over and have we peaked? And are we now destined to slowly erode this risk premium away over the coming weeks and months? Or is the coffee market, does the coffee market still need to do some work? And so I'm going to try to answer that question in the next 30 minutes over the next 35 slides or so. First is the production. Now, this is not going to be a traditional supply and demand presentation where I'm going to run through every one of my production numbers with you and give you the balance in the sense of a bar chart over 2021-22. I think that has been done quite a bit already. You already have seen a number of those presentations, I think. And so what I'm going to do is latch on to a couple very important dynamics. But prior to that, I just want to give a little bit of insight. So the market peaked at $2.60 on the Arabica futures exchange, and it was up from $1.40 prior to the frost. What occurred in the frost and the drought was, in our view, the market lost around 18 million bags of Brazilian coffee over the 21 and the 22 seasons. And I say lost, that is from what we would have anticipated if weather had been normal. We also lost some mild coffees as the Colombian crop was lower, the Honduran crop was lower for a various number of reasons, mostly a function of bad and inclement weather. The rally also skewed quite heavily what was going on in the Brazilian internal market. There was quite a lot of Brazilian selling initially, that really slowed down. And then on top of that, we had a freight crisis where all of a sudden the availability of coffee at destination became very, very tight, and the ability to get coffee out of origin became a concern. And what that did is it reduced the destination stocks and also the certified stocks quite quickly. And that also had an impact on the flat price. That's kind of where we are today, I think. This is old news, and we have been dealing with these factors over the last 6 to 9 months. Now, let's talk about the Brazilian production. Now, the coffee industry, the coffee trade, roasters, and press, and everybody is fixated on the Brazilian crop number, for better or for worse, probably more for worse. And not to suggest that the Brazilian crop number is not important. It is by far the most important dynamic fundamentally in the coffee market, but we have to take everything with a lot of caveats. Now, I have here the on-season production of Brazil in blue, and a trend running through that. And our number for the 2022-23 crop is 40 million bags. This is based on a tour we've done in Brazil in December, and we will need to confirm that with a Brazil tour soon. But 40 million bags is a number by itself, and any number by itself without a relative comparison is useless. And so we need to take some things into consideration, and you should take these things into consideration when anybody gives you a Brazilian number. One, given the unknown and given the size of the area and given the difficulty in actually understanding what is going on yield-wise, we should always give an expected plus or minus range of about 5%. In years like this, for example, where we have a lot of unknowns, the impact of this frost, how much pruning was done, maybe that plus or minus should be more like 10%. So any number, 40 million bags, for example, should actually be a range between 38 and 42, or maybe even 36 and 44. 2 million bags in Brazil is not a lot of coffee and can get lost very quickly. So it's difficult to backtest this, but this is the kind of idea you should have when looking at and when hearing Brazilian crop numbers. Also, we need to come to a conclusion about what that crop number means relative to the person's overall balance sheet of Brazil. If it is a gigantic crop number, what is their Brazilian consumption? Because many times what occurs is that they can have a very large number, but they can also have a very large Brazilian consumption number. Our consumption number of just under 21 million bags gives you an indication that there is a 22 million bag Conalon crop, a 40 million bag robust Arabica crop, and they'll consume around 21 million bags. All of that needs to be taken into consideration. Also, what is the agenda and what is the history? There are dozens, quite literally dozens of Brazilian crop number figures that get released, whether it be a function of somebody putting it on LinkedIn or an actual report. And all of them need to be taken with a grain of salt. You should have, with a good crop tour, around 300 survey points. So if one person, for example, says that they've been able to give you a crop tour by themselves, you already have to be somewhat suspect. And so taking all that into consideration, how important is the Brazilian crop number? And the idea behind it is that it's not that important, because if we think about it, the weather impacts have already been priced in. The market prices in the weather already at the beginning of the South American rainy season in October and November. And therefore, this number, I think, is already very much old news. And gone are the days when I think a trade company can release a report and move directionally the market in any kind of meaningful way. Maybe some daily move, but given a change in direction over the long term, I don't think that it exists anymore. And so what becomes more important than the actual number is things like flow and sales. Now, flow are basically the exports. And what you have in front of you now is the green Arabica exports on a monthly basis out of Brazil. And what I've also thrown up here is a sort of proxy for what the global consuming world needs for demand. You can see it's around 3 million bags. And so on a monthly basis, for example, here between October 20 and April 2021, the Brazilian exports exceeded what I think is the consuming demand of Brazilian Arabica. Now, what happened in May of 2021 was there was a big chunk and a big reduction. And so anything that is below the line means that that coffee needs to come out of destination stocks. And this hole that was created here between May 2021 and December 2021 equated to around 3.7 million bags. Now, that hole meant that roasters had to find spot coffee, and they were able to. Some of them used spot coffee that wasn't on the certified stocks. Some of them used the certified stocks. And we saw then the destination availability drop very quickly, and the certified stocks drop very quickly as well. And that directly had an impact on the flat price in October and November. One, it had an impact because roasters started to buy very aggressively because they were worried about their overall supply. And two, it actually then prompted speculators to notice that the situation was getting quite tight. And again, the export flow is indirectly and directly a function of the production, but it is also a flow of how much business is occurring, what the price is, and what the carryover is. There is more to it than just a number. And you can see here in the gray a forecast for the coming few months. And seasonally, generally, there's a reduction. We have that reduction here. And we think that the amount of business that's happened in the past coming months has resulted probably in the coming months a lower flow. And that is, going to be somewhat supportive of the market, depending on a number of other factors that may be in play. Now, physical flow is one thing, and then paper flow is another thing. You have here in orange the New York price in Brazilian currency, and in black you have the COT report origin short. So this is the proxy for how much coffee has actually been sold into the market. Brazilian producers will sell to the trade. The trade will take hold of it, or at least take hold of it on paper, and then on the futures market they will hedge that, and that flow then hits the market. And Brazil isn't the only Arabica producer in the world, of course, and in theory it has only a small percentage of its coffee that is actually tenderable, but a huge amount of that coffee, the Arabica coffee, is actually hedged on the New York Arabica contract. And so there is a relationship between how the price in Brazilian currency changes and how much is being sold. And you can see, interestingly enough, that at the end of 2021, the origin short actually starts to trend lower. Now, there was still a little bit of a pickup in the price, and this may be a function of running out of supply, and probably more a function, as I mentioned earlier, about the slowing of the market to try to ascertain and digest what was occurring with regards to the price and how much flow was actually going to occur. But what we can say is that the hedge flow is an important aspect of that Brazilian crop, but it's not a function necessarily of how big the Brazilian crop is, because Brazilians, if they wanted to, and they have in the past, can sell not only the current crop, but the future crop as well. And when they have the forward curve working for them, both in coffee and in their currency, selling forward actually can be quite advantageous. Now, again, I think it's very important to note that the origin short has been trending lower over the last couple of months, which suggests to us that the Brazilians are not selling very much anymore, probably a function of the fact that the strength of their currency and the stability in New York, or the downside in New York, means that the price they're seeing now is nearly what they saw last September. But it's also then, like I say, one of the two dynamics that we're much more interested in than simply the total headline number of what our Arabica production number is. Now, shifting a little bit to the milds, and I'm not going to spend so much time on this, but what we find is that because of a Colombian crop that is lower, 12.4 million bags in 21-22, and a Honduran crop that is lower as well, we think that the exports of milds are going to be lower than they were last year. Now, this is important. What I've done here is I've added the Super 6 Central American countries plus the Colombian to give you an indication. Also implied here is the Peruvian exports as well. And you can see that as we're coming up now, we're not reaching the heights that we were a couple of years ago. And in the next coming months, we're going to trend seasonally lower. So what we find is that there is not going to be a big uptick in the mild supply. Now, that's important for us, because what we see is that there is quite a tight market in the milds. And I'll talk about demand in a second. Demand certainly hasn't been very good in the COVID period. But what we can say is that the mild demand seems to be holding its own. And there are a number of reasons for that. But first, I want to focus on this. In graph form, you have here on bottom the Colombian Excelso differential back to the 90s. And on top of that, I have the New York futures price. Now, the relationship of differentials to anything is a little bit difficult to correlate and pin down. Sometimes differentials correlate quite well, with the New York market, usually in a negative correlation. Sometimes it correlates quite well with the supply. But because differentials can be a function of the positioning of the market, whether that be middlemen, producers, most likely trade, they don't always act like they should. But what we found in the last couple of years is that the mild differentials have given us an indication, one, that the markets have disassociated with the New York futures price, and two, that demand is robust and strong enough that there is not necessarily enough supply to reach it. And this is kind of illustrated here. What I have on the bottom axis is the Excelso differential that you see in graph form here. And on the side axis here, I have the New York price. And between 2017 and 2020, the price of New York basically ranged between 90 cents and $1.30. And you can see how the differential then moved from around 13, 15 over to around 50, 55 over. Now, in 2020-22, you see here in green, we have a differential that is expanding at the same time as the flat price New York. So a positively correlated relationship between the differential and the New York flat price suggests to us that this is a market that is tight and that there needs to be some demand shifting out of it because it is trying to price up. And it is suggesting to us that the New York market is not doing enough of the job. And therefore, we have a situation where the demand remains robust enough that is pushing these markets up, and it is disassociating from New York. So if we take that into consideration, the mild production situation in the short term and in the medium term, at least, that looks somewhat tight, and the Brazilian situation where in the short term, at least, we wonder about the availability of flow on the paper side and on the actual physical trade side. Taking all that into consideration and thinking a little bit more on the medium term, the market at $2.20 is in theory offering a profit to any producer in the world, and therefore we would expect an expansion potentially of area and a growth of production relative to what we would have been if we didn't have an increase in price. That was a lot, and this is what I'm trying to explain here. Now, what I want to do is I want to pull out non-Brazilian Arabica production. Robusta production is a little bit different, although it actually mimics this quite well. And Brazilian production itself is very different because not only do we have the cycles, but we generally have almost continuous growth now for nearly 20 years, except for some weather events. What we have here in blue is that non-Brazilian Arabica production on a seasonal basis. And I've just thrown here a trend line over it to give you an indication that generally we're following this trend, but there's some ups and downs. And on top of that, I've thrown the New York price because coffee, like any agricultural market, is going to change and be influenced by price, because when price is high, theoretically, producers are going to want to produce more. And initially, that is a function of added fertilizer, more husbandry, but then theoretically also could incorporate more area into it as well. And so to give you an indication of that, I've thrown up all of the past 5 price rallies in the green table to the upper right. And what I've done is I've looked at the production response over the trend line. So in theory, agricultural production on a yearly basis should grow because yields are growing because we're becoming scientifically and agronomically more efficient, and yields are always improving as we improve what we're growing. Coffee is the same as corn and wheat and everything like that. But of course, weather plays a role in that, and of course, price plays a role in that. And so, for example, in year 1 after 1986, after the 1986 rally, the production increased over trend by 1.5 million bags. Year 2, about 1 million bags. Year 3, 3.6 million bags, et cetera, et cetera. Now, in general, then, we should expect somehow, usually, a production response of between 2 to 3, maybe even 4 million bags, depending on how long the price stays high and how high it goes. However, For the next coming years, we are a little bit concerned, simply because all is not well, let's say, in the market to improve the production of coffee. And mostly I'm talking about the fertilizer cost. Here I've thrown up the three elements of NPK, which are the three basic elements of the most basic fertilizer. And there are a lot of other things that coffee producers will put on a crop, but I'm wanting to include these because these are the most important and the most basic. And I've normalized it all to the beginning of 2000, the year 2000. And you can see Arabica there as well. And you can see that in 2007 and 2008, there was a fertilizer crisis that resulted in prices, and everything is normalized. So you can see that the urea price and the phosphate price basically was 10 times what it was 7 years ago. And we are actually now trending to the same sort of levels. Urea prices are already above that. And while potassium and phosphate haven't grown that much, this is a monthly price and doesn't yet include April, we anticipate that these prices will continue to grow for months, I think. Even if we see a relatively quick end to the Russian-Ukrainian war, we will still see very high fertilizer prices. And while the 2022-23 crop is not necessarily in danger simply because of the timing involved in fertilizer application, et cetera, the 2023-24 crop, which is the crop that we would start to anticipate a price response, is in danger. And so if we think about how price and fertilizer can influence the output of coffee, basically a function of signals given to producers, we can actually sort of break that out. And so this is what I've tried to do here. Again, I'm looking and I'm mostly focusing here only on the non-Brazilian Arabica production. And what I've done is I've taken non-Brazilian Arabica production and also Colombian production, the change versus the trend. So that means that this period here between 1987 and 1990, for example, the production of non-Brazilian Arabica was around 7 to 8 million bags more than the trend, what we would anticipate, given that growth on yields. And you can almost succinctly come to a conclusion that growth above trend was a function of price, and growth below trend was a function of price for many of these aberrations or deviations from the trend. But also there is the 2009-10 reduction, which in Colombia was a function of weather and the renovation program. But we also saw wholesale a reduction in output for nearly every non-Brazilian Arabica producer. And that, in our mind, was a function of the high prices of fertilizer in 2007-8. And in black here, you see the urea price on a seasonal basis. And so, again, the fertilizer price today and the fertilizer price in the coming months is going to far eclipse what we saw in 2008. And while there is an availability issue potentially as well, let's just focus on price. I think that is going to really hamper our expectations of production. And so instead of envisioning this current price increase, the current boom we're in, resulting in a 3 million bag increase in output over expected production, we think it's going to be much more modest, maybe 1 million bags, which is almost just close to an error term. So in theory, we almost see no increase, simply a function of the fact that costs have increased so much. And like I mentioned earlier, the price growth that we have had in the futures market in Europe is relatively modest in a real term. Now, let's shift over to the demand side. Now, again, I don't want to go through individual countries and talk about demand. I want to be relatively succinct about it. This is global demand growth. And demand used to be one of the most easiest things a coffee analyst had to deal with. You would pencil in 2% growth moving outwards. You could do it 10 years in the future. And while price certainly had some aspect to it. We would see destocking, which in theory would mean potentially some lower demand. What COVID has done is it has really impacted consumer demand. And this is a 12-month running sum of consumer demand for the whole world. That is mostly Europe, and North America, Japan, Korea, and Oceania as well. Now you can see that there was a big sort of uptick right before Corona. And then when Corona occurred, we really had a reduction. And we've done a lot of work trying to figure out where exactly all this demand has gone. And it's, I think, clear to us that the world, on a relative basis, doesn't consume less cups of coffee, maybe a little bit. There are less coffee moments probably during the day, but in general, we think it consumes about the same number of cups of coffee. But it has to do with where the coffee is consumed and how efficient that consumption is. If the world's workforce, or to pick a country, the US's workforce is not going to work and consuming coffee at work, or going out to the local coffee shop and consuming coffee, which is produced using something like 25 grams, and instead is staying home and using their machine, which uses something like 9 grams, the more efficient use of coffee has actually volumetrically reduced consumption to a similar amount to actually the volume we've lost. All of this is, well, there's a lot more to this, but suffice it to say that we think the world continues to consume almost as much coffee as it did before in a per cup basis. But what we think is happening is that as out-of-home consumption volume has dropped and much more efficient roasting has occurred, we see lower use of actual volume coffee. Now, two aspects that we think are important is, one, we think that the COVID nadir has been hit, in the sense that, at least let's hope, no longer will we see major lockdowns. No longer are we going to have a situation where nobody's going to work. And we think that the saturation of consuming at home has probably reached its peak. K-cup machines in the United States, for example, at 38 million per household, that's a lot. And that growth since 2019 has been staggering. But we anticipate that trend has now changed. Now, what we don't know, and what is a big variable, is how much we return to the normal pattern of coffee consumption moving forward now. And what we've done is we've kind of put it in a half-half. And that is in the sense that we still think people will somewhat work from home, maybe 1 or 2 days a week, and there will still be a fair amount of coffee consumed at home. So nobody is going to return to going to the coffee shop on their way to work, at their lunch break, all of this. And so all of that means that we will grow from where we are now, but we are not going to take a big leap step up to where we were in 2019. All of that, of course, with the caveat that the demand of coffee never drives the flat price, in the sense that there are no data metrics, I think, that speculators are really that interested in, and it's all very much a backward-looking metric. So I think it's going to get better, and I think that is somewhat supportive of the market, in the sense if we think that in the balance sheet it is making it somewhat tighter. But I don't know that metric or that dynamic is necessarily driving any kind of purchasing from any of the positioning. One major negative aspect to demand that has occurred is the Russian-Ukrainian war. It's difficult to model this because, well, it is a tragedy, and it's difficult to think of it in coffee terms. But if we think of it in the volume aspect, we don't know the duration of this. It's tough to think about, but what we have done from our side is to assume that hopefully within the coming month or so, there will be some sort of resolution. And that will then allow some kind of return to normalcy. And now coffee, of course, isn't the most important thing going on there. In fact, there is a humanitarian tragedy that needs to be dealt with. But what we think is going to occur is that around 1.5 million bags of coffee demand has been lost. One, of course, the Ukrainians, the 5 million of them now have left, and there is very little trade, et cetera, or time for coffee in the Ukraine. And in Russia, what we find is that not only has the price increased, although the ruble has revalued quite considerably, we think that there will still be, because of the market and because of the economy, some demand loss to price and inflation. Now, that is illustrated here. On a 12-month basis, you have the big graph, and on a monthly basis, you have the smaller graph. And this is the period that we have entered with our forecast moving forward. Russia is a 4.5 million bag demand center, in Ukraine about 1.5 million. Most of that is Robusta. So all of a sudden, the Robusta balance sheet in the short term has become a little bit more fluid because there is a little bit more coffee that isn't being demanded. And keeping that into consideration, if we take a step back and look at the global demand, the arbitrage between the markets and I think the availability as well should suggest to us that there is going to be a shift of Robusta from Arabica to Robusta. And this is what I'm illustrating here. You can see that in 2013-14, we saw a significant shift of demand. And while we don't necessarily think it's going to be as extreme, because quite a lot of these blends have already been skewed somewhat to the Robusta side, we think there is going to be above trend Robusta demand growth and below trend Arabica demand growth on the consumer side based on this arbitrage. The Robusta side in 2021-22 was already above trend, but had to be adjusted lower now because of the Ukrainian-Russian situation. Now, a somewhat forgotten area of demand, of course, is the Brazilian local consumption. Brazil, the second largest consumer of coffee in the world, and the most dominant and important point in which the blend shift happens, because the Brazilians are able to produce a significant amount of Conalone and Arabica, and because they're able to relatively easy, I'm not a roaster there, but I'm making that assumption, shift the blend, what we think has occurred in the last year is a dominant move to Conalone. Now you can see that here. The exact opposite happened in 2016-17 when we had a lost Conalone crop, and we saw a very strong reduction in Arabica use. Now, I have this playing out now for 3 years. What I do with my balance sheet generally is I make the balance sheet based on what the price and commercial levels are at the moment. So the moment the differential and the local arbitrage between the varieties suggests to us that there should be maximizing Conalone demand and minimizing Arabica demand. After 24-25, I just revert back to average levels, but this will have to change as we see price indications move. This has wide-ranging implications. One, it has reduced the availability of Conalone for the international market, and exports went from a little over 5 million bags to 3 million bags last season, and will likely stay at 3 million bags, even though the Brazilians are going to harvest a record crop right now. Two, it, like I said, is a way for major deficits of Arabica to be firstly absorbed and reallocated. The Brazilians are very good then at being a circuit breaker in some ways for the overall global balance sheet, because they're able to make that shift very quickly. How, again, that dynamic changes is we're going to have to see in the balance sheet. But also a good point to add here is that the Brazilian Conalone production continues to grow. 22.5 million bags we think will be harvested this year, and that is only going to continue to grow. At some point within this decade, I imagine that we will talk about Vietnam and Brazilian production almost nearly at parity. How much of that continues to be absorbed by the Brazilian local market is a good question, but clearly, if it grows as it is, more and more will be available for international market, even if the blend is at 80% Conalone. And so the international market, I think, is going to have to get used to more and more Conalone in their blends. And I don't think that that's much of an issue, but it's going to be something new relative to what we had 10 years ago. Now, shifting from demand to the stocks are a visceral and very important data metric for the commercial side, that is the roasters, and the speculative side. I here have shown just the change in stocks from the 2-year average. So the coffee market, interestingly enough, has relatively large stocks compared to other agricultural markets, mostly a function of the fact that unlike other crops, we can't increase the acreage every 6 months. And so coffee generally is willing to pay for relatively high stocks. But the market jumps quite considerably when we see these stocks drop very quickly. And so you can see here in orange, which is again the change in stocks at consuming countries compared to the 2-year average. You can see that the 2010-11 rally, for example, which again was a function of much lower than expected output out of Colombia, a much reduced Arabica crop due to the fertilizer crisis, and then that clearly resulted in the reduction of destination stocks very quickly. And right now, this is up until December because stock data is actually relatively hard to find. We are at a level where we haven't been since that 2010 level. Things have gotten a little bit better in January and February because of the Brazilian export flow. But we wonder if that is going to potentially get worse in the coming months before it gets better. And this all very much depends on how the Brazilian flow comes. Now, those were total destination stocks. Clearly, some of those stocks are not readily available for the general public. We did it because we are a trade, but what is readily available for the general public, and with that I also mean the speculative community who doesn't really have a lot of insights into the coffee market, are the certified stocks. And what I've thrown up here is the Arabica certified stocks in the New York market flat price. And there's a cycle in the Arabica stocks. You can actually go back and go through every single down cycle of the Arabica stocks, which is in that blue table there. And they can include the massive 5 million bag drawdown in 1993 to 1995, or the current 1.1 million drawdown we're currently experiencing at the moment. The price change is the Arabica futures price change. So in general, aside from the 2001 to 2002 and 95 to 96 years, although there are reasons explaining that, price almost always is rallying when certified stocks are falling. Now, certified stocks have stopped falling for the very short term, as there have been a number of regrades and even a couple of bags of new coffee have made it to the board. But from our perspective, we don't know that we see a very large influx of new certs available for the Arabica market, at least until 2023. We also anticipate that there will be some demand for these certs in the next 12 months. And so our view is that while there continually may be some regrading and whatnot in the short term, in general, we expect them to continue to fall for the next 6 to 10 months. Now, that means that we're going to go back to that level where we haven't been in over 20 years. And I mentioned earlier, it feels and it seems, and the differentials are telling us that the mild markets have disassociated themselves with New York simply because the supply and demand are not allocated or not connected anymore to the New York market, which seems to be a much more resilient market. That means that this extra coffee may only be available from Brazil, which again may have some bags in 2022, but more likely, and a significant amount, will have to come from 2023. So it depends on what your view is and how much this cert coffee is going to be demanded in the next 12 months. Now, many people show a graph that starts in 2000, so you never see the cert levels of the mid-90s when they were essentially zero. So we have to remember that the Arabica market can and has existed with certs at nil levels. And if you need more insights, you can look into markets like cotton that has a certified stock that also can sometimes bounce around zero, to suggest that there are possibilities that we may have a situation where we basically exist with a much lower level of certs that we are used to for the last 20 years. Which is interesting because the cert number as a percentage of total stocks at destination are actually quite low. And that continues to drop over the last 20 years. So in orange here are the European total warehouse stocks. In blue is the Arabica certified stocks in Europe. And in black here is then the share of certs as total stocks. And it's interesting because is the market therefore, with regards to structure, offering a carry for just the certified stocks, or is it offering a carry for all of the inventories that the trade is trying to carry? And that requires another hour presentation, and I won't go into now, but is an interesting dynamic. Now, the paper market is fascinating, and it really has a lot to do with the volatility that Sarah was talking about. And I'm not going to try to explain it all, but one of the factors that we've had to deal with over the last couple of months is the war in Russia, and how the war in Russia has actually influenced and impacted allocation over the last couple of weeks. Now, this graph is relatively busy, but what I really want to point out to you, or that there is a class of commodity, which include grains and energies essentially, and a class of commodity, which is coffee, the other softs, and the equities, that are being diverged as money is being pulled out of coffee and equities and being put into grains and energy. And the scale of which it's being pulled out of coffee is impressive. Here I have the non-commercial long position in the Arabica market. These are the speculators, the short-term speculators, the medium-term speculators who are buying because they anticipate the price and the flat price is going to go higher. You can see here this position from around 61,000 lots to about 29,000 lots. They liquidated 28,000 lots over a couple of 4 weeks, which is the third largest liquidation in the history. The previous two was the financial crisis in 2008, you see in 2008, and a very large liquidation that occurred in 2016 when the position was at a record high. What's occurred is Arabica has no longer Arabica no longer has an interest for the speculative community because one, it is at a relatively high price, but again, a nominally high price. And everybody is much more interested in buying commodities that are being influenced and impacted by the ongoing war and the ongoing relationship between the West and Russia. To give you an indication of that, we in the coffee industry are clearly, we feel that we are in the midst of a boom, and we are. Coffee price at $2.20 is even high relative to average, and at one point we were at $2.60 clearly. But if we think about it, since April 2020, and April 2020 is that moment when the COVID panic ended and everybody in the fund community realized that they needed to put their money back into commodities because one, it was a bearish US dollar story, and a falling US dollar means raising commodity prices. And that transitioned into a very high inflation story, which means you should buy commodities as a hedge. And that then, of course, was massively juiced by the situation with the war and what that meant for supply. And you can see here, this table is basically the flat price of all of these commodities, agriculture, energy, metals, since April 2020. And while coffee, Robusta, and Arabica have had a relatively decent performance at 67%, they are at the second tier of all of them. And if we think about relatively high and mainstream exchange traded commodities, aside from gold and cocoa, coffee is very low on the side. So, you know, it's interesting. We have to think of things relative, and relatively speaking, our rally is not impressive at all, especially given what has occurred in the last couple of weeks to some of these markets. And that has to do with how they're buying. And this graph is looking at the speculative positions of all the agricultural markets in the United States. It's the range between the high and the low. And coffee has consistently ranked either in the top 5 or the top 4 of all 15 markets since April 2020, until 4 weeks ago, when it was when it was dumped essentially, and no longer was an interesting commodity for anybody. Now, this for me won't last necessarily, because agricultural markets, of course, change, and speculative interests change very quickly as well. Now, I just want to say a couple of things about the short side. The speculative short positioning sometimes in coffee has gotten very large, especially when they think the market is overvalued and there is a carry. But generally, they don't short the market when there are very low certified stocks. So we're not so concerned about a very large speculative short being built, as long as the certified stocks remain around this million bag level. And then the commercial side. In roasters here in blue, that is their length. The origin, like I mentioned before, in orange, which has fallen very significantly and is at the lowest level now as it was in the beginning of 2020, when the flat price was $1. From here on out, roasters probably will still want to continue to maintain at least this level and grow if they can find liquidity. But the origin short does not seem to be giving any sign that it's going to grow. And so one of the aspects of potential future movement is that while the New York market doesn't always need to solve everything that sometimes people say, it does need to bring in more interest from the Brazilian producer, either on the flow side, physically in exports, that is helping trade make markets, and on the paper side, which is the hedge flow, which will then show up here in orange. And then one final thought in something that is probably much larger than one final thought, and probably needs another hour presentation itself, is the macro world. What I've thrown up here is the inflation in the United States in dark brown, and the Federal Reserve rate, which has just started to increase there. The point here is that money has never been destroyed. The value of money, that is, has never been destroyed at this rate before. And so something needs to change. This is not sustainable in my mind. And either inflation needs to continue to run away, or the Federal Reserve needs to really ramp up the interest rates, which will have its own implications. Let's do a thought idea here. There's around $2.3 trillion of money in circulation in the United States. $2.3 trillion is a lot of money, but it's an economy that is much larger than that. So if the interest rate on a monthly basis on $2.3 trillion is giving us about $1 billion in interest, but the inflation is destroying about $17 billion. So the value of money is being destroyed as never before, all the way back to the 70s, since we started the Federal Reserve rate, and something needs to happen. And that then, for me, translates probably into buying commodities. And that's what funds have been doing. This is the fund position for all of the agricultural markets in the United States. And prices aren't quite as high as they were in 2010 or 2008, depending on the market. But we are just off the all-time high of the fund allocation in markets in the US. So I think that coffee is now going to potentially start to be a little bit of an outlier on the downside. And that means it's going to get a little bit of support through that. But it may take some time before coffee is rediscovered. It depends a lot on what's happening, the geopolitical situation, the war, and etc. Okay, that's everything I have on the slides, and I would be happy to answer some questions.
Thanks a lot, Keith. I have a first question, actually. You spoke in your last couple of slides a lot about positioning and certified stocks, mainly for New York market, meaning the Arabica. How do you see the dynamics for the Robusta market?
Yes, the Robusta market seems to be in a little bit of a holding pattern at the moment. The situation from my perspective is that in Q1 and the beginning of Q2, we have a surplus of Robusta. And this surplus seems to have been made worse by the Russian-Ukrainian situation. But the surplus is a function of very good Vietnamese output. Now, seasonally, Robusta does go into a deficit in the second half of the year. Now, I think that this deficit is going to be more than the surplus. So it's going to become tighter quicker than I think a lot of people are anticipating. And therefore, what we see in the certified stocks is interesting because we may actually see coffee come into the certified stocks and very quickly come back out again as it is needed to be commercialized. And that is really on the function, again, that not a lot of Brazilian Conilon is coming out. And also, of course, we see that the freight situation, I haven't talked about that at all, remains an issue. And certainly from East Asia, Southeast Asia, as well as Indonesia, it's going to be a problem.
Okay, thanks a lot. And maybe more on the demand side, because you mentioned a much more efficient way of consuming coffee with the shift from out-of-home to in-home consumption. How do you see the demand shifting regionally? So meaning for producing countries and consuming countries. Do you see demand do you see differences in reaction towards higher prices and higher differential?
It's something that we're constantly monitoring. And so there are differences. Brazil is a great example. We think that Brazilian consumption last year fell, not by much, but if we think that Brazil was a major engine to global demand growth over the last 10 years, the fact that it is actually now leveled off and has fallen is relatively significant. Other origins, we still see it growing quite strongly. And that includes everything from Colombia to Vietnam to India, where growth rates are between 5 and 10%. The consuming world is interesting because we see a dichotomy as well there as for example, more developing countries focusing more on Robusta, less on Brazil's. And like I say, and the big hitters of Western Europe and the United States, also somewhat different depending on the country and depending on how they consumed. Italy, for example, is an interesting dynamic because they were such an out-of-home coffee consumer that the COVID really knocked the whole thing back. Whereas in Germany, we didn't notice much of a difference because the Germans are just used to drinking their coffee at home anyway. So the answer to your question, it really depends. And trying to track that down has meant that demand is a much more intricate and volatile variable than it ever has been before.
So we're gonna have still a roller coaster ahead of us. I'm just now reading through the chat, and there's a question on farmer defaults on forward sales in Brazil and Colombia. What is your view on that? How do you think things will play out in the next couple of months?
Yes, Neil Rosser. Neil, I'm so glad you are part of the next generation of the SCTA. How far do you think the possibility and actual farmer defaults on forward sales in Brazil and Colombia has motivated decline of commercial short position? I think that it has been a huge, well, I don't want to overstate it, but the idea that the Brazilians never stopped selling, that's not a function, but the fact that the selling rate dropped even when the price in reais was increasing, especially in Q4 of 2021, can be, in my mind, directly attributed to a market that was frozen in some ways. And that frozen market was really a function of the fact that the Brazilians had sold quite a lot of their production at a much lower level. And so one, it's hard to equate that directly to the default aspect, but what we can directly equate it to is a sort of underwater aspect to what these producers were selling at. And so if you were a producer and you had sold an average of the 2021-22 crop at something like 800 reais, and the market was sitting at 1400 reais, clearly there's going to be a step back, and clearly there was. I can't attribute the defaults necessarily directly to that, but I can attribute the defaults as part of the whole package that really froze that market up. And, you know, to this day, in fact, it's still a little bit limping along. And so, you know, anybody's view on how the market is going to evolve over the coming months really has a function of how the Brazilian seller will change, and if they will go back to the kind of selling they did early 2022 and late 2022, or will it be the kind of selling we had in 2021 at the end? So I'm not able to answer it succinctly, but of course it was part of it.
Good, thanks. There was another interesting question from Xenia, asking if there would be a stronger relationship if we will be looking at the certified stocks and the GCA stocks combined in relationship to the market levels. What is your opinion on that?
We've done a lot of work in trying to figure out not only the certs, the GCAs, but the KC as well as the structure. The relationships and the correlations are there in some ways, but let me see if I got the question right, actually. Thank you very much. And the relation of KC with stocks certs, would there maybe be an even stronger relation if we say add the GCA plus certs, both hard data points for the market to see? Yes, yeah, absolutely. It's tough necessarily to tease statistically out how all of that works, but the GCA used to correlate quite well with the certs. You can say in the 90s, for example, we were at the lows, just like we were in the certs. 2010 was a low, and there's that dynamic. But the problem is that since the certs in the United States have gone to zero almost, the GCA and cert relationship no longer holds. So while historically we can see a relationship there, in the past short term, that relationship has broken down, and we have to wonder if those correlations will hold.
And maybe a more general / long-term question for you. With all the weather changes that we are seeing, so higher risk of frost, droughts, severe incident on crops, how do you see the coffee market going forward, let's say in a 5 to 10 years time frame? Do you think that we will have sufficient production to meet the demand, or is climate change a real threat for our market?
Well, I think climate change is clearly a threat, but as an agricultural economist, I think the market will always clear, in the sense that perhaps people will have to pay more for their coffee because, one, the implicit risk associated with weather means that the volatility will increase, and therefore, one, either the market needs to hold higher stocks, or two, needs to pay producers more to ensure the viability of it. I could see that as a likely scenario moving forward. Really, while I think markets are working, I'm also very clearly understanding how negative externalities are continuously occurring, and climate change, of course, is maybe the biggest one of that. And there needs to probably be some kind of risk premium associated with that. And maybe we've already started to see how it's being played out this year. It depends. We'll see really an answer to that in the bust cycle of this market, and whether or not we go back down to levels of 95 cents, or the market is unwilling to drop to that level, and there's many scenarios. We find a situation where the milds complex is basically given that premium through the differential.
Thanks. I think we're going to stop here. We're 10 minutes over time. I know there are a couple of questions that are not answered yet, but maybe we can just write them down and answer them separately. Is that okay for you?
Sounds good. Sounds
good.
Fine with me.
Thanks a lot, Keith. It was very interesting and very happy to have you on board today.
My pleasure. Thank you very much for hosting.
Thanks. Thanks, everybody. See you soon.
Bye, everybody. Thanks for joining.